You know, when you picture the stock market, you might think of traders yelling on a packed exchange floor. But that world is, well, it's mostly gone. Today, finance is digital, and now it's getting incredibly smart. Artificial intelligence isn't just some buzzword anymore. It's completely rewriting the rules of market analysis, and it's doing it at a speed and scale that is just, frankly, beyond what any human could ever do. So, how much has it taken over? Well, you're about to find out.
Think about this for a second. Right now, as you're watching this, up to 80% of all trades on the US stock market are not made by a person. No, they're executed by automated algorithmic systems. The machines aren't just participating in the market anymore, they are the market.
All right, so here's how we're going to break this all down. First, we're going to meet the new market wizards, the AIs themselves. Then, we'll pop open the AI Analyst Toolkit to see the tech they're using. After that, we'll walk through a blueprint for building a trading bot. Then we'll look at the ghosts in the machine, the risks and the ethics. And finally, we'll ask, what does all this mean for you, with Wall Street in your pocket? So yeah, we have moved from an era of noisy trading floors to one of silent, chilly server farms. And in these server farms, powerful algorithms are making decisions and executing trades in microseconds. That's millionths of a second. These are, without a doubt, the new wizards of Wall Street. This shift is huge because it completely changes what trading is. Manual trading, the old way, it's all about human intuition, right? Gut feelings, reacting to the news, and that's powerful. But let's be honest, it's also emotional. And compared to a machine, it's incredibly slow. Automated trading, on the other hand, it's just pure cold logic. It's driven by data, by rules that are programmed in, and it can scan millions of data points and execute a trade instantly, 24/7, without ever getting tired or scared or greedy.
So what's actually under the hood of these things? Let's take a look inside the AI's toolkit and really understand the tech that's driving this high-speed, high-stakes game.
Okay, one of the coolest tools is something called sentiment analysis. You can literally think of it as an AI that can read the entire internet's mood. It scans this insane volume of text. We're talking financial news, company reports, millions of social media posts, all to figure out the overall emotional tone. Is the market feeling good about a stock, bad, or just kind of meh? The AI knows this in real time. And to make these calls, the AI is fed a diet of information that is just staggering. It's not just looking at old price charts. It's constantly crunching news, financial reports, social media chatter, even big picture stuff like GDP and interest rates. It's even looking at satellite images of parking lots to see how busy a retailer is. It's a level of analysis that no human team could ever hope to match. Now, at the very heart of many of these systems is a technology like this, a long short-term memory network, or LSTM for short. It's a special type of neural network which is kind of like a computer system modeled on our own brain. And its killer feature is its memory. These little gates you see here, they let it decide what information from the past is important to remember and what's just noise it can forget. This makes it incredibly good at spotting really complex patterns in financial data over time. So, how do you actually go from a blank screen to a real live AI trader? It's definitely a complex process, but it follows a pretty clear, logical blueprint. Building a trading bot actually follows a surprisingly structured path. You start by setting clear goals, like what you want to achieve and how much risk you're willing to take. Then comes the really hard part, gathering and cleaning just massive amounts of data. That data becomes the textbook for the AI during the training phase. But, and this is so important, before it ever touches real money, it has to pass a critical exam called backtesting. You unleash it on historical data it's never seen before to see if it actually works. Only if it passes that test does it get deployed to trade live, and even then, you have to watch it like a hawk.
But wait, how do you even know if a bot is good? It's not just about how much money it makes. I mean, a strategy that makes $1 million but almost went completely broke 5 times along the way, that's a terrible strategy. That's why developers use these sophisticated metrics, things like the Sharpe ratio, which basically measures how much return you got for the amount of risk you took, or maximum drawdown, which tells you the single biggest loss it ever had from a peak. It's all about that balance between making money and not blowing up.
Now, all this incredible speed and power, it isn't without its dangers. When you have these autonomous agents controlling this much money and moving this fast, you get some brand new, really complex risks and some very thorny ethical questions.
This quote here tells the story of the infamous 2010 flash crash. So here's what happened. A big mutual fund decided to use an algorithm to sell a massive $4 billion position. The algorithm was told to sell a certain percentage of the market volume, but, and here's the kicker, it was told to do it without regard to price or time. As it started selling, it pushed prices down, which triggered other algorithms to start selling, which pushed prices down even more. It created this catastrophic feedback loop that for a few minutes wiped out nearly $1 trillion in market value.
So you can kind of think about the behavior of these bots in 4 different levels. Level 1 is passive arbitrage. This is mostly harmless, even helpful. It's just bots finding tiny price differences and fixing them. But then you get to level 2, market manipulation. This is stuff like spoofing, where a bot places huge orders it never plans to fill just to trick others. Level 3 is this ethically gray zone, where bots actively create price differences just so they can exploit them. And level 4, well, that's just outright malicious stuff, like bots designed to attack the market itself.
You can see how this creates some huge challenges. AI models are trained on the past, so they can fail spectacularly during something they've never seen before, like a global pandemic. A single tiny bug in the code can cause millions in losses in just seconds. And when you have thousands of these super fast AIs all interacting, you can get some really unpredictable systemic risks. But maybe the biggest question of all is, when an AI system causes a crash, who's to blame? The programmer? The firm that owns it? The exchange? It's a huge problem.
Okay, that's the world of high-finance supercomputers. But what does any of this mean for you? For the individual investor or trader just trying to navigate the markets? Well, there's a pretty stark difference between the big boys and everyone else. High-frequency trading, or HFT, is a game of microseconds and millions of dollars. They literally put their servers in the same building as the stock exchange to save a few milliseconds. For a retail trader, it's a completely different world. We're talking speeds in seconds, not microseconds. Costs in the thousands, not millions, and much simpler strategies. The resource gap is just immense. But here's the key takeaway. While you're not going to compete with the big institutions on speed, the basic tools and concepts of automation are becoming way more accessible. There are new platforms popping up that let individual traders design, test, and even deploy their own simpler automated strategies. It's putting a little piece of this really powerful technology into more hands than ever before.
And that brings us to our final big question. This technology is, without a doubt, making markets faster and in a lot of ways more efficient. But as we saw with the flash crash, all this speed and complexity also creates new ways for things to break, and to break badly. So as AI gets woven deeper and deeper into the fabric of our financial system, we really have to ask ourselves, are we building a stronger, more efficient market, or are we just building a faster, more fragile one? What do you think? And what are your favorite market analysis tools? Let me know in the comments below, and don't forget to subscribe for more insights into AI and trading.